If you're looking to get started with investing, you're in the right place. Welcome to part two of beginning your investment journey with Mr. Darston. We've covered some things, including getting the inertia behind you, getting up, getting it started. Here, we're going to get into some strategies. Let's go.
You need to invest with a strategy in mind, be prepared to execute that strategy because in the end, that's going to help you have success. So start with a strategy. My advice would be to find investments with a track record. Um, for the last decade, the market has been in an upward trajectory. We've been in an extended bull market. So you could have closed your eyes virtually over the last 10, 11 years, thrown a dart at a dartboard, and whatever investment it landed on, you probably would have made money. That is not the norm. So, in picking an investment for a new account owner, my advice would be to look back beyond years like 2008, where we had the housing crisis and the financial crash, and find investments that were able to endure those bad times. Find something with a track record. If you're going with an investment like a mutual fund, uh, look up how long the management team has been in place. Look up how they're graded, how the funds ranked on a source like Morningstar. You want to get into good investments that are ranked highly, that are very reputable. So be mindful of these things. A track record is important, and also the management team. I cannot emphasize enough in any of my lessons how important diversification is. You'll hear me chime in on this topic over and over again. You must diversify what you hold. When you're building a portfolio, you don't want to just get into one asset class. You want to place your money amongst different asset classes uh, from different regions of the world, even different size companies, different industries. You want to diversify. And you also need to incorporate some fixed income, yes, that's right, bonds, into your portfolio. Now, someone will say, oh, bonds don't make any money. When interest rates go up, there's an inverse relationship, so the value of bonds goes down. Interest rates are at an all time low, so they can't go anywhere but up. I don't want bonds. I'm going to lose money. Well, when equities and investors in equity portfolios run from equities, they go to fixed income. It's important to have it as a part of your portfolio as a hedge, if nothing else. If you decide to invest in mutual funds, not necessarily a bad decision, you want to be mindful of a couple things. Most mutual funds that a new investor could get into are going to be A share mutual funds. Typically, A share mutual funds will carry with them something known as a sales load. I describe a sales load as sort of, let's say you want to go to a club or a bar and there's a cover charge at the door. To get in, you have to pay the cover charge. Well, once you're in, you're in. You have access to everything within the club, but you had to pay a door fee to get in. That A share sales charge is the cover charge to get into the mutual fund. Typically, it's somewhere between 4 to at most maybe 6%. Usually a little bit lower than 6% actually. So be mindful of that if you're getting into most mutual funds with a small amount. Uh, Many mutual funds offer a no load option, but those typically will have a bigger uh, initial investment requirement in order to do that. Now, the advantage of mutual funds is that um, some of them have low investment requirements, so you don't have to have tens of thousands of dollars to get into them. They're flexible. You can make ongoing contributions at any point. Um, they're somewhat diversified in that there's not going to be a mutual fund that has only one stock. It may be only one industry that it's exposed to, but it's going to have a number of different companies that are a part of that industry. So you have some built-in diversification, and it's actively managed. It says on here low cost. Depends on what you're comparing it to. Some mutual funds do have expense ratios above 1%, so be mindful of the cost. And again, I mentioned professional management. You do have money managers that are trying to beat the index. Typically, they'll have a model index that mutual funds are trying to outperform. I can tell you that about 70% or so do not outperform the index. So I'll get into in a moment why maybe investing in index funds may be better than actually managed mutual funds from a cost perspective as well as a performance perspective in most cases. Another option to uh, get started with investing would be to invest in a vehicle known as an exchange traded fund, or ETF for short. This is my preference even over mutual funds because I like the fact that ETFs have lower fees typically. There's liquidity throughout the day. What that means for you is that they can be traded at any time the market's open, much like a stock can, whereas a mutual fund, uh, it, you can only get it at the closing price at the end of the day at 4 p.m. Eastern Standard Time once the market closes. Um, ETFs can be acquired with little money. Now, we mentioned earlier how mutual funds could be low cost and it didn't take a fortune to get into it. Well, even better with ETFs. Whatever the share price is, you can buy one share at whatever that price is. So whether that ETF is going for $20 per share or $300 per share, you can get into it with the very low capital expenditure. Now, again, an ETF is kind of like a love child of stocks and mutual funds. So it has the diversification of a mutual fund that I mentioned previously, but the tradability of a stock in that it can be exchanged and traded throughout the trading day.